The thought of making a heckload of money every year is great, but unless you're planning on working forever, it probably won't last. So, if you're smart, you'll invest a portion of your income in income-generating assets, such as the likes of turnkey businesses or investment properties. This, if done correctly, will help you grow your income safely over the years, and meanwhile, they'll produce recurring monthly cash flow. So, to elucidate on that very idea, we're bringing you in today's video 6 important things to remember in regards to investment rentals for creating wealth. But before we begin, don't forget to subscribe to the channel and press the bell icon so you never miss another upload of the Future Millionaire. Having said that, let's jump right in. Number 6. The power of inflation. If you think the safest place for your money is in a shoebox under your bed, think again. Why, you may ask? Simply because of inflation. Inflation typically causes the price of goods and services to rise over time. This may include food, rent, wages, real estate prices, stocks, etc. The only things that do not increase in value are cash and bonds. In other words, cash actually holds less value over time, making it a poor choice for long-term savings. On the flip side, there is one asset almost always guaranteed to increase in value along with inflation. This asset is the magical real estate. It's because people always have and always will need real estate. As a result, real estate prices must stay aligned with average wages, taxes, and expenses so that residents can actually afford a house. And therefore, luckily for real estate investors, your real estate investment should increase in value along with inflation at a rate of about 2% per year. Number 5. Immediate profits a possibility. It is possible to make profit from your real estate investment within the first 6 months if you know how to force appreciation. This is the process of buying a home and making improvements that increase the property value. The profit is considered forced appreciation because it took effort, not just timing of market cycles or inflation. Number 4. Remember to sell last. This is simply because once you sell a house, that's game over. You will never make any more money off of it. But a property you hold on to dearly will continue making you money every year, with the value of the property appreciating at the same time. The best part is that you don't even need to sell the home to free up money for another investment. You could always refinance your mortgage, which basically means paying off an existing loan and replacing it with a new one. If you'd like to learn more about refinancing, let us know in the comment section below and we'll be sure to honor your request. Number 3. Benefit from fixed mortgages. Fixed rate loan is a loan that has fixed rate for the entirety of the life of the loan. This means that the amount of your loan payment will never change. In other words, what this means is if your current loan payment is, let's say, $500 per month, it will still be $500 per month 10 years from now. In the US, the general public has become so accustomed to this type of loan, that is the 30-year fixed-rate mortgage, that they are now unknowingly taking it much for granted, which is something we strongly suggest otherwise. Why, you may be wondering. Just think about it. If you were to lend money, would you lend it to someone for 30 years for the same monthly payment, knowing the fact that the gradual inflation over the years will eat up its value? Before we move on to the next mind-boggling reason, don't forget to check out our special merchandise that we've prepared especially for you, our awesome fans, linked in the description below. Number 2. Seek loan leverage. Leveraging is one of the greatest advantages employed by smart real estate investors. The Great Investopedia defines leverage as the use of various financial instruments or borrowed capital, such as margin, to increase the potential return of an investment. This is an important concept to understand because it can help you achieve a much higher return on your invested property. Consider this fun fact. Banks will lend you up to 10 loans for investment properties as long as you possess good credit, a current 2-year job history, relatively low debt-to-income ratios, and reasonable reserves. Assuming you are buying a rental property worth around $100,000, you'll need to have about a double of that, which is about $20,000 for a down payment. You may also need about $3,000 to $5,000 for closing costs and almost 6 months worth of mortgage payments set aside safely in savings to cover potential vacancies or unforeseen expenses. All in all, cumulatively you'll require around $30,000 in liquid funds in order to obtain an $80,000 mortgage. With such kind of 80-20 leverage, you will be able to potentially realize returns of 15 to 25% on rental property. Number 1. Use tax breaks to your advantage. Were you privy to the fact that having ownership of rental property can translate into huge tax advantages? Yep, you heard that correctly. You may be able to deduct almost all expenses incurred as part of your cost of running a business, and you can also deduct unfavorable things like depreciation, property taxes, repairs, maintenance, and much more. In the end, all this adds up to a lot of free money for you at the end of the year. With that, we come to the end of today's video. If you have anything to add on the topic of rental investments, let us know in the comment section below. If you found the video helpful, don't forget to like, share, and subscribe. And do join in next time for more of such interesting yet informative content. Over and out.